It's all about how you think. How do you think about the stock market? I mean, what's really happening with your money in the stock market? Are your savings investment in the stock market? Earning a decent rate of return on your money is important, right? With the Fed artificially holding interest rates next to nothing, chances are you're taking some risk with your money. So conventional wisdom tells us the bigger the risk, the bigger the reward. They sell us on these beautiful mountain charts. Look at this one from Morningstar. I mean, that my dollar grew to be $26,000 in in a mere 90 years or so, right? But what if those charts had nothing to do with what your money actually earns? Can there be a huge disconnect between average return, what they sell us on, and actual return after taxes and fees, what we actually get to take home? Let's take a deeper look. Think about it like this. You have $1,000 investment that is guaranteed to average 25% per year. By the way, that sounds great, right? How much money do you expect to have after 4 years? And if I offered you that investment today, would you put money in it? Everybody I've ever asked that says, yeah, I'll put money in that. All right. So let's look and see how it performed. Using some grade school math, it's natural to expect that our investment would play out like this: 25, 25, 25, all 4 years. That's our 100%. And this is the line that we would expect. Our money, our $1,000 would grow to almost $2,500. That's the gray line, right? 25% per year equals 100% divided by 4 years. It's 25% average. Pretty good. Exactly the way you expected. But wait just a minute. The market doesn't always perform as we expect. Alternatively, we can average 25% like this. The first year we earn 100%. The second year we lose 50%. Third year we earn 100%. And the fourth year we lose 50% once again. So this is what it looks like. 100 up, 50 down, 100 up, 50 down. That's 100 divided by 4. That's an average of 25%. That's the Navy line. But instead of having $2,500 at the end, we only have $1,000. That's assuming no fees. So what's the point to that? Average return has nothing to do with actual return. The average return of the gray line and the Navy line are exactly the same. They both average 25% over 4 years. But one is $1,000, one is almost $2,500. So what we expect might be the gray line, and what we get is the blue line, right? The gray line almost 2,500. The Navy line, nothing. We started with $1,000. We ended with $1,000, but they both average 25% per year. I bet you've never seen this from your broker, right? But how would that translate into the real world? So since hindsight is 2020, the next example, we use the history of the market. We're going to have a $100,000 investment this time. We're going to use the S&P 500 with dividends from 2006 to 2015. And you say, well, Jim, it's 2020. Okay, I could use 2000 to 2010. I mean, it's not, I don't want to go back just 10 years, right? Because the market's cyclical. I could pick out 1920 to 1930, 1930 to 1940, because it's cyclical. It's what 10 years are we going to have next? You tell me, and I'll show you how we both will make a ton of money. Okay, now we're going to ignore any fees or taxes for now. We're only going to be comparing the average return to the actual rate of return. So here's the average rate of return from 2006 to 2015. Okay. And we start off with a really good year, up 15%. Now we only have one down year. Now it's a doozy, but we only have one down year in that 10-year period. And we average 9.14%. Now over our $100,000 should have grown to $239,000 is the way we think about it. 9.1% every single year. Remember the gray line? We'd have 239 grand. But these are the actual returns. So your balance isn't $239,000. In fact, it's short by about $37,000. You end up with 202. Now that's not a rounding error. It's your average is 239. Your actual is 202. 16% less than the average. So wrap your mind around this sleight of hand and keep this in mind. Is surprise, this is John Bogle, surprise the returns reported by mutual funds aren't actually earned by mutual fund investors. The difference, 37,000 from average to actual, wasn't lost, it wasn't stolen, it never existed. But you were sold on the average. So ready for the real average rate of return on that $100,000 investment? It's 7.3%. Now, if this was the only factor, it wouldn't be that bad. But we don't live in a utopia. There are other factors to consider. Number one, does this look like your broker? Who's on your payroll? Your financial planner? Man, they're your broker. Let me tell you, they are awesome. He or she is the best money babysitter ever. So needless to say, they're well compensated. We're okay with that, right? Maybe not. How well compensated? So let's find out. So we'll continue with our $100,000 investment featured previously, and we'll assume that there's a 1% assets under management fee and 0.5% internal fees on that $100,000 investment. Now, by the way, if you have $100,000 invested, that's your portfolio, you're going to pay a lot more than that in fees. Boom. Your babysitter just got 27 grand. $27,000. And they're making money, by the way, in the up and the down year, because they don't get paid to make you money. They get paid to hold on to your money. First, we had the 16% from average versus actual. And now another 26%, another 26% between the average versus actual minus the investment fees. 26%. Now, this is Robert Kiyosaki. He says it's not how much money you make, it's how much money you keep, how hard it works for you, and how many generations you can keep it for. So let's rewind, by the way. We're sold average, but we don't earn average. We earn actual, which is not what we're sold, and we don't even get to keep that. Does that seem right? All right, so this is the chart on how this money is eroding before our eyes. We've lost almost half of our money. We were sold $139,000 growth, but the investment only grew about $75,000. That's enough to make you scream, right? Okay. At this point, our real rate of return is down to 5.77%. But we're forgetting something, aren't we? Let's see. What are we forgetting? What do we have to do in this country? Oh, that's right. Uncle Sam wants a piece of your pie. So you can't avoid tax, whether it's in a qualified plan, whether you're postponing the tax calculation, or it's in a non-qualified plan where your gains are taxed annually. The IRS is going to receive part of your earnings. So let's add taxes. So let's pretend that this is non-qualified. 60% is taxed at ordinary income, tax rate of 25%, and 40% we're going to be taxed at a capital gains rate of 15%. Now, by the way, it doesn't matter what you think taxes are now, what capital gains are now, because you're going to do this for the next 20, 30, 40 years or more. So you can't tell me what taxes are going to be in the future. There goes another $36,000 at 25%, that tax blend that we just said. 25% on ordinary, 15% on capital gains. Wow. $36,000. So what do you think of your return on your investment now? It's 3.36%. 3.36%. Remember, we averaged 9.14. How are you feeling about the market now? You were sold $139,000 and you got to keep 39. All right, now think about this for a second. Do you really want to invest in a system where you put up 100% of the capital? You, the mutual fund shareholder, take 100% of the risk and you get 30% of the return? Even John Bogle doesn't think that makes sense, and he started Vanguard funds. So understand what just happened. You saved up $100,000, which on its own is an accomplishment, right? I mean, that's an accomplishment. Excuse me. Then you invested your savings and left it 100% exposed to the market. You didn't touch it. You didn't use it. You didn't benefit from it. It did nothing for you. And your reward? Actual rate of return of 3.3%. Wow. Between the fees, the taxes, the lost opportunity costs, we managed to give up over 63,000 of the actual rate of return. We were only able to hold on to $39,000 of the earnings. Is that a game you can win? Is it a game you should play with your hard-earned cash? If there was a better way, would you want to know about it? And, if what you were doing, you found out, or what you thought to be true, you found out wasn't true, when would you want to know about it? Right now, watching this video. So could we make it worse? I know I just made this pretty bad, and I know you're probably scratching your head thinking, what am I doing? But what if we put this in a qualified plan, right? It's where most people have most of their nest egg. Is that a good idea? Let me ask you 3 questions. I'm not going to tell you whether it's a good idea or not. I'm just going to ask you 3 questions. First question. Do you believe your tax burden is going up, down, or staying the same? Now, not your tax rate, your tax burden, because I could make the rate really high and give you exemptions all over the board, and you could make it work, okay? Because your actual burden wouldn't be as high. Or I could make it low and let you have no exemptions, no deductions. Okay. I don't know if you've answered this question yet, but time's up. Taxes are going up. By the way, why are taxes going up? Because Medicare, Medicaid, and Social Security and the interest on the debt are going to exceed our GDP. That means all the money coming into the country. What's going to happen then? We have to raise taxes. And the average top tax bracket is average since taxes started is 57%. Right now they're 37%. I mean, even if we just got to the average, it'd be 20% more, right? Okay, taxes going up. Agreed? Second question. Do you think the dollars in your pocket are worth more today or in the future? Now, not the money that you have that you're trying to grow. So let me phrase this question or give you an example of this. When you were a kid, how many candy bars could you buy for $1? Now I'm 54. I could buy at least 5. Okay. Now I know that some of you young guys are thinking 5 candy bars. That's what it was. Now think about it today. How many candy bars can you buy today? You can't even buy 1, 0, nothing for $1. So I don't care if it was 2, 5, or 10. The dollars in your pocket are always worth more today than in the future. Last question, because I know this is not making you happy if you got a lot of money in your 401k. When you're thinking of paying taxes, would you rather pay tax on the seed, the little amount? This is for people that aren't farmers. No, I'm just kidding. Or the harvest, the big amount. Ask any farmer, they'd pay tax on the seed in 2 seconds. The little amount, that's the hint, right? Okay. Pay tax on the seed now, and you get all the corn tax free. That makes sense, right? Qualified plans like IRAs, 401ks, and 403bs violate all of the questions you just answered. So between average versus actual and qualified plans, how can you win that game? You can't. So, is there a better way? Is there an alternative way, an unconventional way of building wealth? There is. Controlling the banking function in your life. So, how do you learn how to do that? You go to createtailwind.com, you sign up for one of our free coaching sessions, and you learn how to do it. And after an hour, you'll know whether this is right for you or not. So, thank you for spending a few minutes with me today. I'm Jim Oliver, founder of Create Tailwind. Have a great day.